Hi friends, most people struggle to remain financially stable. So in this video, I want to speak about a very powerful financial rule called 12, 20 and 80. This rule could be very powerful thumb rule to boost our financial immunity. This rule can work like a vaccine. So when we take a vaccine, what happens? Our body's immunity goes up and therefore our body is protected from various types of diseases. So this rule of 12, 20, 80 can boost our financial immunity. So as per this rule, what we need to do is first component, which is 12 here, we need to plan for an emergency fund and we need to plan for 12 months of expenses into emergency fund. I will speak about more details about how to actually individualize it, how to personalize this, how to calculate your emergency fund personally depending on your situation. Second component that you see is 20 here, simply meaning that 20%, up to 20% of your savings you can consider to park in gold. And right now gold prices are soaring. We'll speak about gold briefly as well in this video. And the third component is 80, meaning up to 80% of our savings can be parked in equity or stocks. And in the long run, 80% of our money can give us a lot of financial benefits. Now, before I deep dive into each components 12, 20, 80, one important note here is that the sequence of this rule is also equally important. So the first component 12 is coming first because you should not start investing your money into gold, stocks or any other asset before you build your emergency fund. Why? Because if you build emergency fund and life throws at you financial shock situations, you will be better prepared, you will be able to handle it, you will be financially immune. Rahul, what do you mean by financial shocks? So let me give you examples. In February 2024 alone, 15,000 people were laid off by 74 IT companies. Even reputed companies such as Swiggy, Flipkart and many other well-known brands started to fire people. And these layoffs are really hard for people and it can send many people to what I call digital begging. For example, what you see on my screen is somebody on Twitter asking for money, asking for financial help, asking for support because they were laid off. Now, I genuinely feel that nobody needs to go through these type of events in their life, but not everything is under our control when it comes to life stages. But what is under our control is to be prepared for such events. Second example is medical emergency. The financial shock people get from medical emergency is like anything. If you look at the data, Policy Bazaar says that in India right now, 66% people pay medical bills out of their pocket. Why? Because maybe they don't have the medical insurance. Maybe they have the medical insurance, but they don't have sufficient medical insurance cover amount. And that is why they're paying these bills from their own pockets. So when a medical emergency comes, bam, they get a financial shock and their pocket is empty. I can go on and continue to give you a lot of such examples. But the point I want to really drive home today is that emergency fund is a must-have in your portfolio, and only after you have built your emergency fund you can consider investing your money up to 20% in gold and 80% in stocks. Let me now explain each of these components 12, 20, 80 in greater details and give you critical points that you must know before you go and build your emergency fund or recheck your emergency fund and before you go and start investing your money in gold or stocks. So the first component is 12 months of emergency fund. There are a lot of questions that come naturally in my mind. Should it be 12 months? Should it be 6 months? Should it be 3 months? Where should we park our emergency fund? What are some of the best practices that people follow when it comes to emergency fund? So I'll give you in the next 3 to 5 minutes a lot of details about emergency fund. First critical point is how much should be your emergency fund? Now 12 months that you see in this rule is just a framework. It is just a thumb rule, but your personal situation, my personal situation may be entirely different. You might need an emergency fund for only 3 months of your expenses. I might need it for 12 months. It really depends on person to person, situation to situation. How to go and calculate about it? This is what I will explain to you now. And for this, I'm going to the sponsors of this video, Stable Money, a platform that I personally trust. So when you go and download Stable Money platform, you will see a button called calculate right in the bottom. So you click on that calculate button. Stable Money will ask you 4 simple questions before it calculates emergency fund for your personal needs. Question number 1 that you will see is which city do you live in? So if you are living in Delhi, Bangalore, Gurgaon, wherever, select your city. Second question it will ask is whether you are single or married, because Number of dependents you have financially on you will decide how much of emergency fund you need to really look to build. So if you are a single person living with parents, go ahead and tick that. And third question it will ask you is how much money you are spending on a monthly basis. Here you must include all the expenses that you are incurring on a every single month basis. For example, rent, all your bills, school fees, holidays, everything on an average that you're spending on a monthly basis, you should go ahead and enter it here. And the last and the final question it will ask you is number 4, which is whether you have insurance or not, whether you have the medical insurance or life insurance or not. And I really hope viewers of this channel, you have both health insurance and life insurance, because it is absolutely important for us to be insured. Now, based on these 4 inputs, it will actually calculate the emergency fund and it will give you personalized emergency fund amount based on your situation. Now, if you already have an emergency fund that you built 2 years ago, 3 years ago, I would highly request you to go and recalculate your money, because your expenses may go and have higher from the time you created your emergency fund. The situations in your life may have changed. You might have got married recently, or you might have had children in your family. There may be various reasons for which you must recalculate your emergency fund. Typically, what I do is I try and calculate my emergency fund on a yearly basis, so that I make sure that if there is extra money I need to park in emergency fund, I go ahead and top it up. Or if I have parked additional funds in emergency fund, I try to withdraw it so that I can invest this surplus money into higher return assets. The link of the stable money you will find in the description or in the pinned comments. This service that stable money is giving is absolutely free of charges. Now, once you know how much of emergency fund you need to have with you, now comes the second critical point. Rahul, we know how much of emergency fund we need to have. So for example, I need to have 3 lakh rupees worth emergency fund. But the natural question is, where do I park this money? Should I keep it in the cash? Should I keep it in the stocks? Should I keep it in the property? And in fact, many people ask me that, Rahul, I already have mutual fund SIPs worth 3 lakh rupees now, or I have stocks worth 3 lakh rupees. Can I consider that as an emergency fund rather than investing 3 lakhs more for emergency fund? My simple answer to you is that you cannot count stocks as your emergency fund, or for that matter, property as your emergency fund. Why? Because if you, let's say, have 3 lakh rupees of stocks right now with you, and tomorrow if market crashes and this 3 lakh rupees becomes 2 lakh rupees, and if there is an emergency at that time for you, and if you withdraw this money, you will be not only in the loss of 1 lakh rupees, you will not have sufficient emergency fund for your needs. And one good example was COVID. During the COVID time frame, Nifty crashed by almost 30 to 35% within few days. And at the same time, mass layoffs started globally. And that is where most people needed money. Just imagine people who had parked their money in the stocks and they needed to withdraw it. They were withdrawing this money at a loss of 30 to 35% and also not having the right amount to fulfill their emergency needs. Therefore, counting the money that you have invested in stocks, mutual funds or property is not the right type of asset that you need to park in your emergency fund. So what are the right type of assets? Any asset that fulfills these 3 criteria that I'm going to speak about is a good candidate for an emergency fund asset class. These 3 criteria are, number 1 is your money needs to be safe. You cannot take any risk with this money that you're putting in emergency fund. So it needs to be a safe asset that you can leave your money in. Number 2 is that being safe is fine, but this money should not deplete over a period of time. Therefore, you must generate at least returns after tax that is matching with at least inflation or beating the inflation at the least. And third point is that you must be able to withdraw this money very, very quickly. In case an emergency spans out, you don't want to sit there for weeks, days and months to be able to withdraw this money. So for example, property is a very, very bad example to consider as an emergency fund, because if you have a property worth 1 crore rupees and if you want to go in the market and sell it off, you're not going to sell it off next day. And if there is an emergency, then what are you going to do? Therefore, these are the 3 simple criteria you can use to select the safe assets. In my view, there are 2 assets that make good candidate for investing your money in emergency fund. Number 1 is fixed deposit and number 2 is liquid mutual funds. And in my view, 50% of your emergency fund can be parked in fixed deposits and remaining 50% can be parked in liquid mutual funds. Now, why this 50-50? Because 50% of your money parked in fixed deposit can give you returns between 7 to 9%, and after tax, this money almost beats the inflation. While at the other hand, 50% of your money in liquid mutual funds can really give you similar returns around 7% right now. But more importantly, you can withdraw this money from liquid mutual funds within hours. So this balance of 50% in liquid mutual funds give you flexibility to withdraw the money within hours. And this 50% money in FD gives you slightly higher returns than potentially liquid mutual funds. Now on liquid mutual funds, if you are interested, I created a full video on my channel and you will find that on my channel. Please go ahead and watch that video. You are going to learn a lot about liquid mutual funds. Coming to fixed deposits, you will find on stable money more than 200 plus fixed deposits that you can easily compare. So for example, if you go and click on Discover and then click on View FDs from 200 plus banks, here you will see a lot of banks listed and you can also see their interest rates. Some of the banks such as Suryodaya, Utkarsh, Shivalik, etc. are giving more than 9% of interest rates. For example, if you click on Shivalik Small Finance Bank, you will see for senior citizens it is giving close to 9.25% interest rate, and for general people it is giving 8.75%. If you go and click on Suryodaya Small Finance Bank, for senior citizens right now it is giving 9.25%, and for general category it is giving 9.01%. These interest rates I am seeing right now is as of 17th of April 2024. When you're watching this video, I don't know, the rates might have changed at that time. Now, one thing you will also note here is that it states here that investments up to 5 lakh in this bank are insured by DICGC, which is a subsidiary of RBI. Second important point is that you don't need to have any bank account with any of these banks if you are opening the FD using the stable money platform. Also, it doesn't mean that if you're opening a FD with stable money, your money is going to stable money. No, your money is going to go directly to the bank that you're opening the FD with. And whenever you want to withdraw this money, what you can do is you can go to stable money platform and can withdraw your money. You don't even need to go to the bank to withdraw this money. It happens all digitally within a few minutes. So if you have not yet built your emergency fund or want to top it up, please go ahead and check out Stable Money platform. I have given you the link in the description or in the pinned comments. Let's come to second component of this rule 12, 20, 80 is 20, which is up to 20% of our savings can be parked in the form of gold investments. Now, personally, I like two good options to invest in gold. Number one is sovereign gold bond and number two is gold ETFs. So on sovereign gold bond, I created a video on my channel that speaks about how to really save a lot of money if you go and buy sovereign gold bonds using the secondary market. I'm not going to detail it out, otherwise this video is going to go really long. You please go and watch that video and you're going to learn a lot about sovereign gold bond and how to buy them from the secondary market. And the second good option is gold ETFs. On gold ETFs itself, I have created a video on my channel. So you will find that video as well on my channel. And if you have not yet subscribed to my channel, I would request you to go ahead and subscribe it. Watch few videos and you see whether you want to remain a subscriber or whether you want to unsubscribe. That choice will be yours. Only after watching the content you will realize whether it is a valuable content for you or not. But coming back to gold investment, I have not yet compared sovereign gold bond with gold ETF and which is better. Both of these products have their pros and cons, and if you would like me to create a separate video on comparing sovereign gold bond and gold ETF, let me know in the comments, and what I will do is I will come up in the next few weeks with a separate video on this topic and I will give you a lot of details. With that, let me now move to component number 3, which is up to 80% of money can be considered to be parked in stocks. So on my channel, you will find a lot of videos around stocks as well. And more importantly, in the next few weeks and months, what I plan to do is I want to release few videos on portfolio building. How to build a portfolio from scratch, for example. When to enter into a stock, when to exit a stock. How many stocks should be there in a portfolio? How to rebalance your portfolio? There are a lot of portfolio strategies that I personally use, and I would like to share those with you without giving you any stock recommendations in the upcoming weeks and months. So you can consider subscribing to my channel. Also, for your awareness, I have a YouTube member community. You can consider subscribing to YouTube member community because I share in-depth analysis of stocks, mutual funds, and various assets almost on a daily basis. You will find the link in the description for that as well. Now this video is getting really long, so I don't want to speak about stocks in this video, but as I said, in the upcoming weeks, I will create few videos around portfolio building. So just to sum it up, 12, 20, 80 could be a very powerful financial rule to boost our financial immunity. And building an emergency fund is the first step before you even start investing your money into gold, mutual funds or stocks or any other assets for that matter. So please make sure you take the first step today and calculate how much money you need to park in emergency fund. You can do that freely using the Stable Money platform. I will provide you the link in the description. With this, I hope you enjoyed this video. If you did, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with more content for you at zero cost. With that, I'll see you in my next video. Until then, keep rocking.